Is the AI bubble about to burst? Today, we're going to talk about AI, specifically what's being called the AI bubble. AI is being hailed as a world-changing technology, but there are plenty of signs that it's repeating the exact same script as the dot-com bubble, or even further back, the railway mania and electricity booms in history. The big players like NVIDIA, OpenAI, Microsoft, and others are creating a financial whirlwind full of illusions. Stocks in AI companies keep hitting new all-time highs, but much of that isn't based on sustainable production, it's mostly financial gamesmanship. So is the AI economy the biggest bubble in history? And if it pops, what will happen? We'll break it down in this video. First off, any breakthrough technology usually goes through a familiar cycle. Initial skepticism, then explosive investment, skyrocketing valuations, and finally a sharp correction. From the 19th century railways to the dot-com era in the late 20th century, this pattern repeats over and over. Now it's AI's turn. We all know AI is already changing the world and will continue to do so. No one denies that. But the money pouring in right now has striking similarities to past bubbles. Many companies are valued sky high just because they're tied to the word AI, not because of the real value they're delivering today, but because the market is excited, caught up in FOMO, chasing quick gains. And the market here isn't you or me, it's the giants through a mechanism called circular transactions. Simply put, big companies invest in each other, then use that money to buy each other's services. For example, NVIDIA invests in OpenAI, then OpenAI commits to buying hundreds of billions in NVIDIA chips. Microsoft pours money into OpenAI, and OpenAI buys Microsoft's Azure cloud. Amazon invests in Anthropic, and Anthropic buys Amazon Web Services. Oracle invests in projects tied to OpenAI, and OpenAI commits tens of billions to Oracle's infrastructure. It sounds complicated, but the essence is, I invest in you, then you take that money and buy my services. The cash just loops around. In reality, it's a limited amount of initial money, but media hype turns it into massive events, sending stock prices soaring, as if there's huge real demand. Just one rumor that OpenAI would spend $60 billion a year on infrastructure sent Oracle stock up 25%, adding $50 billion in market cap. But the question is, where does OpenAI get that money? Their actual revenue is only a few $billion a year, nowhere near enough for hundreds of billions in spending. The main source? Those very investments from the partners they're committing to buy from. This is a beautiful financial loop on paper, but it lacks a solid foundation. It's not fraud, the companies are investing and selling real products, but the growth isn't coming from natural market demand, it's from financial engineering. And history shows these schemes collapse fast when the tide turns. Look back in the 1990s. America Online invested in startups. Startups used that cash to buy ads on America Online. America Online booked huge revenue. Stocks soared. Then they invested more. It went round and round, but there was no real demand. When the market realized it, the bubble burst. Many companies lost 90% of their value or vanished entirely. The telecom sector was even worse. Everyone believed the internet needed massive infrastructure. Cisco, Nokia, Motorola were hailed as gold mines. To sell gear, they lent customers tens of billions to buy their own equipment. Revenue spiked, stocks rose, more lending followed. Result, by 2001, 90 to 95% of U.S. fiber optic cable was unused, dark fiber. When it popped, half the U.S. telecom carriers went bankrupt. WorldCom had the biggest bankruptcy at the time. The Tech Telecom Index lost 86%, $2 trillion in market cap evaporated. 500,000 people lost jobs and savings. This isn't just modern finance, it's human greed. In the 19th century, the U.S. had railway mania. Railway investment hit 20% of the nation's total capital, 7 to 10 times what AI is today. Railways truly changed the world, but investors were over-optimistic, borrowing to build unnecessary lines in empty areas with no cargo or passengers. In 1873, crisis hit, bubble burst, leading to a 6-year recession. Similarly, the electricity boom in the 1920s. Everyone knew electricity was revolutionary, and it was, but everyone piled in, over-borrowed. When the stock market crashed in 1929, countless utility companies went bust. The biggest lesson: technology endures forever, but many companies building it die young. The issue is finance, poor risk management, not enough cash reserves for downturns. Early on, reckless builders who expand fastest often win, but as the market matures, only financially disciplined companies survive. AI will absolutely grow strong, but investing in AI stocks at peak hype makes it tough to hold through a big correction. Beyond financial risks, AI faces monopoly issues. NVIDIA and OpenAI are collaborating extremely closely. NVIDIA customizes chips for OpenAI. OpenAI optimizes models for NVIDIA chips. Competitors have almost no chance. No illegal collusion needed, just smart partnerships to squeeze out competition. Like the old Wintel alliance, Windows and Intel dominated PCs for decades. But AI is far more dangerous. It's not just an OS. It could become the middle layer for all technology: ride-hailing, video editing, smart home lights. If one or two companies control that layer, their power would be enormous. Another issue is the gap between AI theory and real-world application. Companies announce hundreds of billions in AI investment, but in practice, many businesses see little profit. An MIT study shows 95% of enterprises aren't getting the expected returns from AI. Reasons? Employees don't know how to use it, don't trust it, and it doesn't fit workflows well. Result? Buy it, then shelve it. Major AI models are also becoming more similar. Last year, clear differences between ChatGPT, Gemini, Grok, but now they're mostly comparable. AI is entering commoditization. Competition shifts from superior tech to interfaces, ecosystems, pricing, customer service. For sky-high valued companies like OpenAI, if products aren't standout, what justifies the valuation? OpenAI is committing to spending trillions on infrastructure over the coming years. That's too massive for private funding alone, so they're likely preparing for an IPO soon, possibly targeting late 2026 or 2027, with valuations discussed from $750 billion to over $1 trillion. OpenAI's brand is powerful. Many see AI as synonymous with OpenAI, like search with Google. This could lead to one of history's biggest IPOs, but investing here requires extreme caution. Sam Altman is betting on a winner-takes-all strategy. One company controls the AI middle layer. If right, burning massive cash makes sense, like Amazon 20 years ago, losing money to grab market share, then dominating. But if wrong, or even delayed a few years, overspenders face existential risk. So, what does the future hold for the AI bubble? Most optimistic scenario, the market self-corrects. Tech stocks drop 50 to 70%, many companies fail, survivors restructure and emerge stronger. Short-term pain, but a more sustainable recovery. Another, AI firms use inflated stock to acquire traditional businesses, swapping virtual value for real assets. Or worse, the burst causes U.S. economic instability, opening opportunities for other powers. Even extreme scenarios, institutional crises, deep internal divisions. Whatever happens, the lesson is clear. Be cautious. AI will change the world, but not every AI company will survive this phase. Thanks for listening. If you found this helpful, share your thoughts in the comments. See you in the next video.